Welcome back to the Rock and Turner Investment Podcast. We're excited to have you join us for another episode filled with valuable insights and expert analysis to help shape all of your investment decisions.
Today, we're diving into a lesser known yet incredibly compelling investment opportunity. It's a gold mine hiding in plain sight. By the end of this episode, you'll understand why this British small cap might just be one of the most underrated investment opportunities today. So buckle up and let's get started. While the world of artificial intelligence and cutting-edge biotech gets all the attention, some of the best investment opportunities lie in the dull corners of the market. And that's where we find Manolete Partners, a London-listed company with the stock ticker MANO. That's Mike, Alpha, November, Oscar. This is an investment firm thriving in a niche specialist area. As Charlie Munger used to say, the best places to go fishing are the lakes with huge fish that no one else knows about. Well, Manolete has found such a lake. It invests in acquiring rights in meritorious legal claims. But don't tune out. That may sound super boring, but believe me, it isn't. This 20-minute podcast may end up being the most productive 20 minutes of your year. Consider Manolete more like a venture capital firm, but with far less risk and quicker returns. Intrigued? You should be. Here's the thing. Manolete isn't just misunderstood, it's seriously undervalued. Most people lump it into industrials or legal consulting, completely missing the fact that it's actually a financial investment company. And this misclassification has kept its share price low, making it a hidden gem for savvy investors. The best part is that 2025 promises to be a year with a number of catalysts that are sure to unlock this trapped value. So let's dive into what makes Manolete so extraordinary. It was founded in 2009 by Stephen Cooklin, who retains around 10% share in the business and still serves as its CEO today. It opened as a private company, and for the first 9 years of its life, it operated on that basis before raising capital through an IPO in 2018. And that capital raise was designed to accelerate growth. This cash injection allowed Manolete to increase its investment portfolio and to supercharge compounding growth engine. This is a business which, to all intents and purposes, has the ability to generate annual returns on capital of around 17% and to reinvest earnings at the same rate. So while most companies face diminishing returns as they scale, not Manolete. They're playing a whole different ballgame. Every time it casts its fishing line in the lake, it catches another fat fish, a unique ability to compound growth by reinvesting an enormous pool of potential investments. We all know how a venture capital private equity firm operates. It looks for promising young businesses, invests in a diverse portfolio, then hopes and prays that one or two will succeed. And the outsized returns on a couple of winners compensate for the vast majority that never come to anything. It's a risky game and highly competitive, with so many investors fighting over a small number of companies that exhibit some kind of potential. And on average, 5 years later, they might hope for a payback. Well, Manolete is different. It operates by investing in entirely different things. It doesn't invest in companies. It has a 93% success rate, so it flips those odds on their head. And the payback period is around 24 months. And this stability makes the business easier to manage because it's far more predictable, which mitigates all of its operating risk. Manolete dominates the UK insolvency litigation market with a whopping 67% market share. Why so little competition? Well, because the barriers to entry are sky high. Most businesses with the expertise to flourish in this market are law firms or insolvency practitioners, and they're not in the business of putting capital at risk. So this is a niche business requiring deep expertise and a finely tuned operating model. And while some have tried to enter the space, none have made a dent in Manolete's dominance. Its moat is as wide as ever. Here's an interesting story. Manolete is the name of a Spanish bullfighter who was tragically killed by the bull in 1947. In 2020, a company named Rosenblatt Group attempted to encroach on Manolete Partners' territory, and they called their insolvency litigation division Islaro. This is the name of the bull that killed the bullfighter. It was a bold move, and its intention was clear. It was coming for Manolete. But needless to say, it's made no meaningful impact, while Manolete has grown stronger and stronger. And Manolete's operating model is a thing of beauty. They focus solely on case management while outsourcing the heavy lifting to external lawyers and insolvency practitioners, making their business both scalable and efficient. So what exactly are they investing in? To answer this, you need to understand a little legal history. For many centuries, English law prevented third parties from becoming involved in legal actions. The principle was simple. If there's a dispute between other people, it has nothing to do with you, so keep out of it. But here's the thing. What happens if you have a strong legal claim but no money to pursue it? Then justice isn't being served. The party with the deepest pockets always wins regardless of the merits of the case. So the law changed and allowed third parties to fund legal claims, and that justice can now be effectively delivered. But that's only half the story. What happens if the party that has been wronged, with insufficient funds to pursue a legal claim, is in fact an insolvent company? Imagine dishonest corporate management who extract capital from the business, driving it into insolvency, which effectively means that it has insufficient funds to pay its creditors, who might include suppliers, employees, tax authorities, utilities, and banks. So how does the legal system enable the wrongdoer to be brought to justice and for money to be recovered for the benefit of all the creditors? The solution was to allow third parties to acquire the legal claim outright and to pursue the officers of the company in their personal capacity, essentially making a claim against their homes and their other assets. And so insolvency law has become the only branch of UK law where this is allowed to happen. And this is the specialist area in which Manolete plays. So now you have a good idea of what the company does and what makes this investment opportunity so special. Now we need to look at what negatively impacted the share price and why. So let's start by talking about the COVID-19 pandemic. Like most companies, Manolete faced challenges when this once-in-a-century event hit. Courts were closed and government measures suppressed insolvencies. It was a rough patch, no doubt. But here's the twist. When those government interventions ended, insolvencies surged, turning a headwind into a very strong tailwind. UK insolvency numbers in 2023 were the highest that they've been in over 30 years. Remember that it takes 2 years for a payback on investments to materialise, and this tidal wave of insolvencies will start showing through in the 2025 numbers and beyond for Manolete Partners. This will be a key catalyst in the stock re-rating. Another challenge for Manolete was in the way it had chosen to meet accounting standards that were never really designed with this kind of business in mind. The mandatory requirement to report unrealized revenue has caused confusion and even led to a profit warning in September 2022. But let's be clear, these are paper issues, not problems with the business itself. And measures have since been taken to ensure that this doesn't happen again. Then, in the government budget of October 2024, the new British government decided to reduce the tax incentives that had long existed to encourage people to invest in small cap businesses. This resulted in a huge drawdown from the small cap stock space. And when the tide goes out, all boats go down. And Manolete was taken lower with the rest of the market, something that had nothing to do with the quality of the business itself. Today, the share price is near an all-time low, while the business has never been so strong. Demand for Manolete's services is at an all-time high, with case volumes and cash collections smashing records. And CEO Stephen Cooklin believes this momentum from spikes in insolvencies will carry the business into a golden era of growth. So let me hit you with some numbers to really drive this home. In the first half of fiscal year 2025, Manolete completed 137 cases, a record, and net realized revenues rose 66%. But that's not all. The company had some long-running large cases relating to major truck manufacturers unlawfully creating a price-fixing cartel, all of which resulted in insolvencies among the consumers of those trucks. This litigation is more complicated than most, and its cases have been going on for several years now, but it's widely expected to conclude this year. Liability has now all but been established, so it's really only a question of determining quantum for damages. Conservative estimates suggest that Manolete will receive a cash windfall largely equivalent to its current enterprise value today. Just let that sink in for a second. And all the while, the shares are still trading at a small fraction of their intrinsic value. Over the next 12 months, the EV to EBITDA ratio is likely to be less than 0.5. Have you ever heard of such a good company trading at such a valuation? So the million-dollar question, is Manolete Partners a good investment? A business is worth the net present value of all future cash flows. Manolete currently has around 46 million invested, which is growing at about 17% annually. It can also reinvest all of its earnings at a very similar rate of return. This means that the business is able to double roughly every 4 years. Just think about that. Then you've got the forthcoming windfall from the settlement of the cartel cases, which will also be reinvested. And the business is able to boost the value of its investments further with the prudent use of debt. So by the end of 2025, it could feasibly have 70 million invested. And that will grow to around 170 million by the end of the decade, 2030. Now, discount that back to calculate the net present value of this business, and you're looking at something close to 115 million of intrinsic value today, against a current enterprise value of just 17 million. The shares are so undervalued that this is the kind of asymmetric opportunity investors dream about. You don't need to be Warren Buffett to see the potential here. Long-term shareholders include heavyweights like venture capitalist John Moulton and the Saudi investment fund Mithaq Capital, further reinforcing confidence in the company's future. Manolete Partners isn't just another litigation investment company. It's a compounding machine run by a long-term founder CEO. It's a market leader in its field, and it's a misunderstood gem. For a full deep dive and to better understand this business, take a look at the Rock and Turner Substack, where a full analysis has been posted with far more detail than I've shared with you today. Thanks for listening.
We really hope that you enjoyed today's podcast, but we really only scratched the surface. If you want to explore any of the themes discussed in more detail, see the show notes or visit us at rockandturner.substack.com. Oh, one more thing. Be sure to like the episode, share it with others, and save it to your favorites so that you don't miss future episodes. Until next time, we wish you every success with your investments.